Hello and welcome back to the Market Lens. I'm Sam Rozzi, and as usual, I'm joined by Cliff Walsh, American Portfolio's Chief Investment Officer. Please check out our previous episodes available on YouTube or the Studio 454 video library. Well, it seems that spring is just around the corner, so let's spring right into this segment. The conflict between Russia and Ukraine is news, and we're going to need the entire segment to zoom in on this.
Agreed. You want to just ask questions, or you want to get to it?
Yeah, I'll ask. So how does the market discount something like this?
I think it's very difficult. I think you have to take the worst case off the table. At some point, you care less about your 401k than bigger issues, right? So we have to look at the likelihood of rising conflict from here. It's very difficult to discount irrational behavior. Russia has strong nationalistic pride that we've seen, at least at the beginning of this conflict, damage to that pride. Russia doesn't look very good right now. The government's ego is definitely bruised. I think when Switzerland chooses sides, you're in the wrong here, but they don't see themselves as that, and they see every response to what they're doing, whether it be sanctions or supply of military equipment to the Ukrainians. They see that as escalation, and they see that as potentially declaration of war at some point. So it's definitely going to get worse before it gets better. But like I said, it's very difficult to assess.
Yeah, so I think right now, though, the problem is they look maybe too bad, where Putin probably wouldn't pull out or try and come to some type of agreement at this point, because they would just look so poorly in the national sphere and so weak. And that is really the exact opposite of what Putin wants to do. He wants to always look strong, so that may mean a stronger military force with this even stronger Ukrainian resistance backed by the EU and NATO here.
Right, like I said, they have, met with stiff resistance more than I think they expected. They've had trouble, they got the nuclear power plant. They have had trouble holding on to certain areas. They've seen stiff, even civilian, responses to what they're doing. So, I think they need some sort of out, to before they pull back. So either they end the conflict by just, increasing their aggression, or they do make a win here or there. Something happens with Zelensky and they can replace the government, or they can claim that they demilitarized Ukraine, and then potentially they have end on a strong positive. There are other issues that I think will take longer to play out that could potentially cause the conflict to end. One, the economic pain. We haven't yet restricted oil. We talked about it recently. From a government standpoint, U.S. government standpoint, Germany has pushed back on that, so it's not looking like it's going to be immediate. And even if they did agree to that, it's going to take long. I mean, if you look at what's happened in the past when we've done similar things in other countries, it's been 12 months, 18 months where you see that significant weaning of foreign oil happen. You also have the oligarchy in Russia that could potentially put pressure on the government. They're taking huge hits economically, losing billions and billions of dollars of stock value, of their yachts are being taken, their businesses are crumbling. So you have that pressure from the oligarchy and inner circle. You have social unrest. I mean, you're definitely seeing some protests in Russia. There's also a lot of propaganda being spread in Russia, so many of the citizens do support the war because they don't fully understand what's going on. But there is some social unrest, and if they can't handle that, then they could cause them to pull back at some point. But again, these are things that are going to take time, and if we don't see an immediate end to the war, I mean, this is something that's going to take weeks or months to potentially play out.
Yeah, a lot to unpack there. This is obviously a very serious geopolitical risk with various different impacts on the different economies. So let's start with the broader global economy. I'd assume this hurts Europe a little worse, right?
Yeah, obviously, the EU is in a difficult spot, very dependent on, energy supply and wheat. Ukraine and Russia, I think, are responsible for 33% of the, wheat market globally. Like I already mentioned, Germany pushing back against cutting off energy supply because they are so heavily dependent, on Russia. From an emerging market standpoint, I mean, you're definitely going to see economic activity could take a hit from lack of Russian demand, or goods aren't even reaching Russia, and some in some instances, you're going to have benefits from, maybe emerging markets being able to step in for demand, but also they have a Russian market that's not, getting goods. You also had the global shipping company, Maersk, they're not even delivering cargo to Russia at this point. So losses that could potentially occur from that for any business definitely hurts.
Yeah, significant impacts to the supply chain. And probably most importantly for our group of financial advisors at American Portfolios, what about the United States?
Well, I think this conflict, unless it significantly escalates, and that's talking about, enforcing a no-fly zone or, just getting more involved in the war directly, it's really going to be an economic issue. We could see some cyber attacks on the banking system. I think that's a big threat, but really more immediate, where the issues are economically, and we're seeing skyrocketing energy prices. We're seeing corn and wheat prices go up, and that's going to impact our economy. I think this is a precursor to a recession. We're seeing, if you adjust oil for inflation, we haven't reached the 2008 levels. We're slightly below the peak in 1979 of inflation-adjusted numbers. But we think this is something that is going to be a significant tax on the consumer, and it's also this issue is also exacerbating COVID supply chain issues. We're hoping to see the computer chip issues start to get better, see new car prices and used car prices come down. It's going to be an ongoing issue. There's also issues of potentially the Russian default. So that could potentially impact Europe more. Long-term capital management actually started in the issue in 1998 was Russia, an issue with Russia again. So that's definitely, I think, the bigger issue is the financial system and the economy, and I don't see how, we're not going to take a significant hit from this.
Yeah, I mean, the supply chain was in really bad shape before this, and just with the COVID alone, we were asking some similar questions here. So how does the U.S. avoid a recession and or a continued market pullback from here?
Look, I think we can avoid a recession, but I think this conflict needs to end quickly. There's a geopolitical risk premium in energy prices that would need to deflate, rapidly. The longer that this persists, the less discretionary income there is for businesses and for the consumer, and you're just going to see, the economy pull back. We're already on shaky ground. The Atlanta GDP last week was flat for Q1, potentially heading negative in its next reading. You're seeing earnings, start to come down, and we're going to see those expectations for the rest of this year, potentially into 2023, continue to contract. And with the Fed, headwinds, rising rates and such, multiples are going to contract too. So lower earnings, lower multiples, not a great recipe for equity prices.
Okay, we need some good news here. Surely there's some slivers of this market that will have positives, right?
Yeah, well, at first I thought China was going to be, that place, and maybe they are from an investment standpoint. They were starting to become more vocal, but then they started to shift to support their trading partner Russia more. They are going to strengthen, I think, from lower. If everyone else shuns Russia, they're going to have cheaper energy prices, so it will help their economy. I think also from a U.S. perspective, we're going to see rate hikes come out of the market expectations. We've already seen 2 last week come out. I think we're going to see more. I never expected to see 7 or 8 hikes in 1 year. I thought that was way too aggressive, but we're going to start to see the market head in the right direction. I still think we're going to get maybe another 1 or 2, and then maybe the market settles in and expecting 3 or 4, and we'll go from there as things develop.
Yeah, I think, it's just so clear that the Fed funds expectations have been extremely volatile with all this geopolitical risk and the risk of the supply that came from the supply chain and COVID. But thank you for the insight, Cliff. This was very interesting and I think very timely for a lot of advisors. Also, do not forget that registration is open for this year's national conference at Mohegan Sun in Connecticut on May 18th through 20th. You can register at connectionsap.com. Thank you everyone who watched, and we hope this is letting you see 2020. Take care.